Well, sell America remains the broad theme for financial markets at the moment, with equities continuing to slide, the dollar trading to three-year lows against a basket of peers, and Treasuries selling off as the curve twist steepens. Focus clearly remaining on the policy uncertainty on the trade front, but we've now got President Trump attacking Fed Chair Powell to throw into that mix as well. It's a busy data docket as well this week, with flash PMIs, the data highlight, due on Wednesday. Plenty of central bank speakers in the mix as the IMF World Bank spring meetings take place, and tons of corporate earnings too, with this week being the second busiest of Q1 reporting season. Plenty to discuss on the trade-off this week, so without further ado, let's get on with the show. So lots going on, and as always, joining me to try and make sense of everything is my good friend Ryan Littlestone from Forex Live and Forex Analytics. Ryan, a very good afternoon to you. And amid all of the nonsense that's been going on over the last week or so since we last spoke, I suppose the most important development is Arsenal's progression to the semi-finals of the Champions League, having beaten twice the mighty Real Madrid.
Let's go straight into topical Thunder 1, shall we?
Sorry, I'd just like to remind you of how much you gloated about West Ham winning that pretend European trophy a few years ago, and just prepare you that it will be that times 100 if we do end up winning later on in the year.
Yes, that's a very big if. So if you don't, I'm going to remind you of this show in particular.
Oh, I'm sure you will. I'm sure you will. But in all seriousness, let's get straight into things, because we do have plenty to discuss this week. Right, so for once, I'm not going to talk about trade to kick us off this week. Instead, I'm going to talk about something else that President Trump has been doing over the last week or so, which is deciding to attack Fed Chair Jay Powell. Clearly, he wasn't content with causing upheaval by all the tariff to and fro, and has decided that he's going to turn his ire back to the Fed instead. Last week, we had Trump noting that Powell is, and I quote, always late and wrong. He was also saying that Powell's termination cannot come soon enough, which was a rather sinister sounding threat, to be completely honest with you. Trump then went on saying that Powell will be out of there if he is asked to leave, and then doubled down on all of this on Monday, calling Powell a, quote, major loser, and nicknaming him Mr. Too Late. I'm sure given some time, Trump can come up with a slightly more imaginative nickname than that, but never mind. To be completely honest with you, all of this is absolutely ridiculous. I think most people who watch this show, and also the various other bits and bobs that we do, will know that I think Powell has done a pretty good job over the last 7 years. He's had a hell of a lot to deal with, obviously COVID, 40-year high inflation, engineering a soft landing last year, now potential stagflation amid a trade war. But I think the issue for Trump is that rates are not low enough for someone who is ultimately a bankrupt real estate developer. They are not going to get on particularly well with a Fed funds rate at 4.5%. We did have some weekend reporting by the Wall Street Journal, their sources noting that President Trump has discussed firing Fed Chair Powell and potentially replacing him with Kevin Warsh, which is, to say the least, ironic, given that Trump actually picked Powell ahead of Warsh in 2018 when he gave Powell the job. Now, to be clear, Powell has been resolute in saying that even if he is asked, he will not resign. It is also, as the legality of this stands at the moment, at the time of recording, not possible to fire the Fed chair apart from for cause. Now, that is a term generally taken to mean either a criminal offence or some degree of gross incompetence, clearly neither of which categories Powell falls into. It's also worth bearing in mind, in addition to that, if by some miracle Powell was forced out of his role as Fed chair, he would remain a governor of the Fed, and the FOMC, which is the monetary policy making body, elect their own chair. By convention, that is the chair of the Fed, but they would probably just elect Powell to carry on in that role anyway. The problem, though, is even though the base case is that Powell will survive until May of 2026, there is absolutely nothing to stop either President Trump or the Treasury Secretary Scott Bessent from naming his replacement much sooner than that and effectively having a shadow Fed chair. What I mean by this is you name Kevin Hassett, Kevin Warsh, whoever it might be, as the next Fed chair in Q4 of this year. You then just send them out in the media to make as many interviews and as many speeches as you possibly can, get them to give as much guidance as they possibly can along the lines of, when I take the reins in May, I will do X, which ultimately means that markets pay attention to the new guy instead of the old guy, no matter what the old guy is doing. I think the broader point here is that all of this, whether it be the talk about firing Powell, effectively the guarantee of having a kind of yes man coming in as his replacement next May. The point is that none of this is doing anything to help retain the haven attraction or the reserve status of US assets, which, let's be honest, were already under threat given all of the nonsense that we've had on the trade front. And market participants did not, and clearly have not, needed any further encouragement to trim their exposure to US assets, as we've seen in the price action over the last week or so. Now, personally, I think Trump would be very, very wise not to be fiddling around with the Fed. It's worked perfectly well for a number of decades. Why change it? I would also say that it's unlikely he is going to stop these attacks on Powell anytime soon. And as a result of that, I think the capital flight out of the United States is probably not going to stop anytime soon either.
Well, not the term you use that they've done very well for the last few decades. How short your memory is when they completely botched things up in the inflation saga. Well, you said it, mate. So not for me to pick it up your indiscretions, but I will do so. So yeah, central banks always have it tough. We know that. Yes, they did mess up back in the inflation blip that we got. They were completely behind the curve. The curve with that, hence why they had to chase things higher. But yeah, since then, I think he's learned that lesson, Powell, and he has steered things pretty straightforward. He doesn't really shift too much from sort of the central line that he's following at the moment. I think you're right. I think that, talking about a new Fed governor, putting someone in, having him squawking on the news wires and whatnot everywhere he can, I think that just leads to more uncertainty for markets, and there's enough of that going on at the moment. So I don't think it will do the US or Trump any favours whatsoever, but that's what's going to happen. If it's going to happen, he's the man to do it, and we'll have to deal with the consequences.
Indeed, and it certainly looks like we are going to have to deal with those consequences potentially sooner rather than later. Anyway, away from that nonsense, plenty of data due this week.
Yeah, absolutely. And, given all the Trump trading going on, the market really sees nothing else matters as far as what goes on with the data. But we do have some data this week, and that data is worth watching. Now, the first thing, and one thing we've been highlighting recently is particularly in the US, that we're seeing a lot of this soft private data and sentiment data coming through, but we're not yet seeing it in the hard data. And that was also noted by Feds Williams last week too. Secondly, the market, I think, is waiting for this hard data to start rolling over. And so it's going to pretty much ignore, any half decent data while it chases that ball. Like we saw with the US data last week, we had retail sales, we had housing, we had jobless claims, industrial production, all sort of holding up pretty well. Yet that offered no relief to the markets whatsoever. And we actually saw a bigger reaction when we got the poor Philly manufacturing data, which is only a regional survey, but it was a bit of a clunker, and markets reacted to it. Now, part of this story with the data is that until we really start seeing that hard data rolling over and all this tariff mess actually having an impact on the data, whether that's activity globally slowing or whether it's just the US that's going to see problems, as they sort of turn inwards and stifle trade, and whether we see other countries benefiting from that, like the euro, because they're boosting business in other markets. Or even if we see the tariffs impacting inflation, as a lot of people are expecting, and which way that goes. Until we start to see that, then the market is in this vein where it's going to brush off reasonable data and really react to bad data. Now, unfortunately, with the central bank trade dead and buried for the next few months, the data is really only important for judging US trade policy for all the things I've mentioned above. But among other things, as you mentioned, Michael, we've got the PMIs. So really, we've got to judge this data through the lens I've just described, if you're going to trade it. So it's not about the central banks now. It's about whether we're seeing the impacts of these tariffs and these trade policies impacting the hard data and the other data to come.
Yeah, I think you're absolutely right. So I think the general sort of way that participants are kind of looking at the data at the moment is if it's sort of holding up okay or broadly in line with consensus, then it's a case of, well, it's going to roll over at some point when the impact of these tariffs arrives. So it's more a case of slowdown or recession fears postponed rather than averted entirely. And then, of course, as you said, if we do get a big miss, like on that Philly Fed number last week, then that just crystallizes those concerns. So I think it's going to need a change in tone in terms of that trade rhetoric and in terms of those tariffs in order to move us to an environment where actually the market does get a sort of shot in the arm and a dose of optimism from upside data surprises. There's also the fact that, as we've discussed at length before, so much of this data is skewed horrifically at the moment. I mean, you look at we had Chinese GDP out last week. Now, again, all the usual caveats apply with that, but beat expectations because exports went through the roof. Well, why did exports go through the roof? Because everyone's trying to export from China in Q1 before the tariffs go into place at the start of Q2. So what's going to happen in the Q2 number? Well, exports are probably going to fall off a cliff and GDP will come in below expectations, or at least much, much lower than it was in the first quarter. So it's also this issue where participants are dealing not only with data that is delayed, but also data that is skewed by everyone trying to front run everyone else.
Yeah, exactly. And you've got to know what mindset the market's in when it's looking at data. As I say, it's not going to get all bullish over good US data. It's not going to see the dollar rallying, 500 pips or anything like that. The market's going to see that, get the rally and think, right, well, we still think bad data's coming around the corner, so we're going to sell that rally, and the markets go back just as quickly. And then conversely, like you say, you get a bad data point, no matter how minor it is, and the market gets hammered for it. So if you know what the market's doing with the data, you know how to trade and react to it.
Absolutely. And in terms of the central bank trade and monetary policy divergence, I don't think anyone could give monkey's toss about that at the moment, to be completely honest with you. It's all about trade. It's all about what Trump posts on Truth Social next.
Yeah, and good job you're going to talk about the ECB next then, isn't it?
Well, indeed. Yeah, let's move on because the ECB were one of the first G10 central banks to get a chance to react to the whole Liberation Day nonsense last week. The Bank of Canada as well, who of course held rates steady as expected. Setting aside the appearance of my doppelganger at the post-meeting press conference, the ECB did indeed duly deliver the 25 basis point cut that market participants have been expecting and also kept their policy guidance unchanged, stressing that they'll take a data-dependent, meeting-by-meeting approach with policy not on any sort of preset course. You'd have to have been living on Mars for the last 6 months to have not been expecting the ECB to say that. What I thought was more interesting, though, was that we saw the policy statement explicitly note how the market response to the tariffs that have been imposed has had what they termed a tightening impact. What we mean by that is effectively the way markets have reacted has tightened financial conditions. So in order for them to stay as loose as the ECB want, they are probably going to have to cut more and potentially cut more quickly in order to effectively offset the tightening that the move lower in equities and the move higher in treasury yields has caused to the overall state of economic conditions. So I thought that was an interesting remark because it just points to how the Fed are grappling with this stuck between a rock and a hard place of risks to both sides of the dual mandate, effectively stagflation, whereas other G10 central banks are sat there going, well, tariffs for us in the rest of the world represent disinflation and downside growth risks. And that's effectively what the ECB and such like are going to have to cushion against. Now, Lagarde's press conference was very much one for the purists. There was really not any clarity in anything that she had to say. There was one odd analogy, so to speak, that you picked up on, Ryan, about not wanting to swim in the same water twice. I'm not even going to go there because trying to translate that is not even worth bothering with. But as I just alluded to, I do think this has effectively given a bit of a blueprint for what the ECB have done, has given a blueprint for everyone else in G10 to basically go, we're going to try and cut as fast and as deep as we can in order to cushion the economy from the downside growth hit that this global trade war is going to cause. Now, of course, there will still be some degree of fallout and some degree of damage, but the job of central banks at the moment is to ensure, firstly, that inflation remains close to that 2% target, and also to cushion that downside impact as much as they possibly can. Now, this goes back to what we were saying a moment ago. Ordinarily, when you're talking about 9 G10 central banks, well, 8, set the Bank of Japan aside, 8 G10 central banks doing as much as they can to ease, and the Fed stood there on hold with risks actually very, very, very balanced in terms of what they do next. Well, ordinarily, you'd sit there and you'd look at your textbook and you go, well, the dollar's going to be going through the roof on the back of that. But it's not. The dollar's trading at 3-year lows against a basket of peers. Euro dollar's at its best since November 2021. Cable's up through 134. Dollar yen below the 140 mark for the first time since September this morning. And all of that, again, speaks to the point I raised earlier. The market could not care less about policy divergence at the moment.
Yeah, very much so. And I'm actually going to jump back to the Bank of Canada because I think they set the way, because this ECB meeting that we just had wasn't a forecast meeting. And what happened at the Bank of Canada was a Macklem tip before the meeting altogether, at the prior meeting, actually. He said, our forecasts aren't going to be worth the paper they're written on. And in fact, they didn't actually give any forecasts at that meeting. It was a monetary policy report meeting where you usually get updated forecasts. And basically, they threw that in the bin and said, right, well, we've got 2 potential scenarios, one where things might be not so bad and one where things might be really bad. And we don't know which one it's going to be. So we're not going to bother about anything until we find out what path we're going down. And I expect that's the way that central banks are going to go. The ECB, their next forecast meeting is June. I think the Bank of England, that's May, so that's going to be a forecast meeting. Yeah, that's going to be a forecast meeting as well. And I think they're all going to go the same way. We don't know what's coming. So we're going to perhaps give you a range of forecasts rather than a direct route, and you can get on with it, everybody. And we're none the wiser. We won't be none the wiser for another 6 months.
Well, I tell you what, it's probably a pretty safe bet that no matter how many scenarios they outline, something completely different ends up happening anyway. But I do think that's a very, very good point. And actually, Lagarde leaned into that idea at the ECB. She was asked about the neutral rate. Of course, the ECB have spent months banging on about whether policy is restrictive and where neutral might be in the Eurozone. They concluded that study, I think it was February. The neutral rate is somewhere between 1.75% and 2.5%. We're about 2 months on from that study being released, and Lagarde said that it is completely and utterly meaningless. And right now, neutral does not matter at all. And actually, it's one of the few things that Lagarde has said recently that I completely agree with. Because what is the point of these sort of theoretical macroeconomic constructs and the best economic model in the world when the plans of every business, every consumer, and every investor can change literally in the blink of an eye at the moment?
Yeah, absolutely. But I do think that, having an idea of the neutral rate is important, because even if they end up shooting through it on the downside, where they want to particularly or potentially get it back to if and when things settle down after that. So at least it may be a number that means nothing now, but keep it in the back of your mind as to what it may mean going forward in the future, depending on what rates have done in the meantime.
No, that is a very fair point. Right, well, we've spent a long time banging on about Europe, and now we're going to spend slightly longer banging on about Europe again.
Yes, we're going to talk about euro dollar. And how was your lunch? Have you had it yet? After you've got your 110?
No, it's booked in for this Friday, actually, my celebratory lunch and Ryan's commiseration lunch. I assume he'll just be having a starter, having seen the menu.
Where's he taking you? Is it?
I can't tell you that. We'll have our legion of fans following us.
All 3 of them, yeah. We'll
that many?
Exactly. But yeah, no, congratulations on that one. But I want to talk about the euro dollar, because we have had a big break up through the 115 level, but I'm always dubious about breaks that happen over holidays when there's low liquidity, and Easter's the perfect case for that. This has been the perfect case for euro dollar at the 115 level. Now, this was one of my really big one of my top 5 levels, and it really is massive. Now, I'm not saying everyone should just pile in and sell this level or get into shorts, because we know which way the wind is blowing right now. And it was only a few weeks ago we were trading down at 105, so 1,000 pips lower, and we've come a long way. So we know which way the trend is going. Now, last week we spoke about investor flows, and this is a reminder that when there's big structural shifts in markets, they don't happen quickly. They don't obey technicals, and they certainly can drive markets much further than people might think. However, we can still use the techs and the levels as a bit of a guide as to where those flows may stop or may at least run into some trouble. Now, all that said, you need to understand that these are not markets for messing around with 10, 20 pip stops in. Mm. When we're trading new big figures pretty much every day, you need to adjust your strategies. And we spoke about this last week as well, to account for the volatility and size of the price moves that are happening at the moment. Now, one way to do that is to trade smaller size and maybe wider in your trading price range. It doesn't mean you need to risk any more or any less than you were if you were trading less volatile markets, but you just need to factor those conditions into your trading. So back to euro dollar and looking at the chart, if we do confirm a break here at 115, there's every chance we keep pushing up. And I wouldn't rule out a move up to 120, and that's yet again another big, massive level up there. But until then, a lot of the upside levels sit around the big figures, 116, 17, 18, all the way up to 120. However, if we do fail to hold 115 over the next couple of days ahead, and if we do find it showing as resistance again, then that would indicate that at least we may be pausing in this phase, and a move back to maybe 114, maybe even 113 couldn't be dismissed.
Yes, no, very good. I think your point around how these sort of moves pan out over a number of weeks, if not months, if not years, as opposed to 2 or 3 trading sessions, is a very, very important one. And also they are, I know I mock the technical analysis folk quite a lot, and I'm going to do it again, but they are not the sort of moves where, I've drawn a line on a chart, so it must stop here. If we are talking about a world that is looking to some degree at least, de-dollarize and diversify reserve asset allocations, that is the sort of flow that will just go on and on and on, and will drive prices to levels where you think it probably couldn't get to. I mean, I will happily, you joked about my lunch earlier on, I'll happily hold my hands up and say, I would not have expected the euro to be trading at 115 in mid-April, and I certainly wouldn't have expected it to be trading here for the reasons that we are trading here. But such is the way of the market. I would also say that we have, in a lot of these sort of trades, come a very long way in a very short space of time, whether it be this broad-based dollar weakness, or whether it be something like the move in gold. I mean, I was looking at the numbers on gold this morning. Obviously, we're trading at $3,500 an ounce now. Spot gold has gained 3% or more. This is going back to the start of 2000, by the way, on just 48 trading days over that time period. 3 of those trading days have come in the last 2 weeks, which gives you an idea of how unusual and, dare I say, unprecedented the scale and the speed of some of the moves that we've been seeing of late is. But again, it's the sort of flow that I wouldn't want to be fighting. Again, the levels can give you a little bit of a steer, but I think the broad trend of financial markets at the moment is clearly one where, whether it be foreign exchange, whether it be fixed income, whether it be equity, participants want to reduce their exposure to the United States. And again, that doesn't mean to say we're not going to have days where the dollar rallies or weeks where the dollar rallies. What I'm saying is the broader trend seems to be becoming embedded of the path of least resistance leads lower for US assets for the time being.
Yeah, very much so. I just want to go back to gold, and just to give our viewers a little heads up. For watching that trend, keep an eye on the clock in Asia between, and these are UK hours, between pretty much midnight and 3 a.m. because for days and days and days, with few exceptions, you can see Asia buying coming in that period, and it's pretty strong. So if you're trading gold, look for a period where you don't see that price action for several sessions. That might indicate maybe a little bit of a top forming, at least temporarily. But back to euro dollar and flows, and we were discussing this today on my flow show. It's when you get these big structural shifts, okay, you get this reallocation of assets, investment firms, hedge funds, whatever, they move out of one jurisdiction into another. It takes a long time to move all that money. There's trillions and trillions to move. So you get those big flows happening, and that can take a long time. But then what happens is, moving forward, you've just shifted all your assets from one thing to another. You're now going to be telling your customers, right, if you've got money to invest, you're going to invest in these assets. So if you've got customers now continuing to invest in Europe, then that's going to keep the move going, because now all the flows are dedicated towards European assets, whereas before they were going into US assets. So you get this initial big move, then it still carries on moving because future business is also going that way as well. So it's something, it's like the tide changing the sea. Once it moves, it takes a long time before it changes back again.
Yeah, that's a really good point. And just lastly, to kind of hammer home this one, it will get to a stage potentially where you're kind of sat there and no investor wants to be the last one out the door, which is then when you really start to see the momentum. And I think that's to a degree what we've probably seen over the last couple of days, where you're kind of sat there and you're going, well, every other market participant seems to be selling down their exposure to the US. So why am I the only one not doing it? And I think as time goes on, more and more portfolio managers will end up asking themselves that very question. And ultimately, you don't want to be the one that gets a tap on the shoulder when things go wrong and you're left holding a load of US exposure and everyone else has got out, because that's going to be a very difficult meeting for you to get involved with. But anyway, we could talk about that until the cows come home. We probably shouldn't, and we should get on to our plays of the day. Right, I'm going to talk about the S&P this week, keep it relatively short and sweet. We have kind of marked out a range since Liberation Day, to coin the phrase, between about 4,900 to the downside and about 5,500 to the upside. And as I speak, we trade as near as makes no difference, bang in the middle of that range. I think the highs and lows at this point are pretty well defined, to be completely honest with you. My bias personally remains for further downside in the short term, at the very least. As we go through earnings season, we see earnings expectations revised lower. We see economic growth expectations continuing to fall as well. I think the other thing that's increasingly starting to play on the minds of market participants is we're supposedly getting 90 trade deals in 90 days. We've currently had 0 in 13 days, and even the ones that were meant to be easy to strike, such as Japan, seem to be running into quite a few roadblocks. So I think selling rallies is my preferred strategy for the time being. I don't think it's likely we break those lows given how things are at the moment. But if we get a further ratcheting up of trade tensions between the US and China, for example, then certainly don't rule that out. I guess the other question is, what drives further upside? Were we to get an outright dovish pivot from the Fed, you'd probably retest those 5,500 highs. I think there's a bit of a long shot that actually happens, though, at this moment in time. Similarly, if Trump were to pull a concrete, proper U-turn on the whole reciprocal tariff thing, maybe that gets us a test or a break of 5,500 as well. But I think that is probably a long shot too. So for the time being, I am favouring further downside in risk. Ryan, Dolomex.
Yeah, but before I do that, I remember we had a conversation about the S&P and whether it would ever trade 4,800 again when we're all sailing up near the 6,000 figure. I noticed in that drop we got to, I think 48.09 was a low, or 12 or something like that.
Very close. 48.23.
Something like that. Yeah, very, very close. So do you think that 4,800 might be traded now?
Well, I'm certainly a lot more nervous about that call than I was when we were trading at like 6.2 or whatever the high was at the time. 48.25. I must admit, I was thinking I'd have to go and eat some humble pie. Yeah, I mean, look, come on, the low is 23 pips above the level, so I think the possibility of 4,800 trading again is relatively high, at least considerably higher than it was when this topic last came up.
Yeah, exactly. But it just goes to show, doesn't it? Everyone wants to buy a level when you're 2,000 pips away, but when you suddenly get there, it's a different kettle of fish altogether. But
that's very true.
As you say, moving on. So yeah, I'm talking about dollar mex, another quick one here, and I'm looking at potential further breakdown in this pair. It's a bit of a continuation of a trade that I had a couple of shows ago when 1990 was important support, and we broke that. 1963 is the important line here and now. So I'm looking to either add to shorts on a retest and hold of 1990 or go with a break of 63.
Very good. Well, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Live and Forex Analytics for joining me. Thank you also to our producer, Kyriakos, for bringing things together as brilliantly as always. And thank you, of course, for watching as well. Hopefully you've enjoyed the show. If you have, do please drop a like on the video. Leave a comment as well. Let us know how you're trading the markets and how you're seeing everything that is going on at the moment. And the three of us will be back this time next week with another episode of The Trade-Off. And in the meantime, Ryan's off to go and buy himself a new alarm clock. While he does that, I will wish you goodbye and we will see you next week. Thanks as always for watching. Goodbye for now.